Imagine waking up tomorrow and discovering that the price of oil has jumped again. Not because the world suddenly ran out of oil, not because global demand exploded, but because one narrow waterway, one political decision, and one confrontation in the Middle East suddenly changed the risk calculation for the entire world. That is the danger surrounding Iran right now. The United States is tightening economic pressure on Tehran. Iran is warning that it will retaliate against countries cooperating with Washington. And sitting between these two forces is the Strait of Hormuz, a passage so important that roughly 20 million barrels of oil and oil products move through it in 2025. That is around a quarter of global seaborne oil trade. And the bigger story is not simply whether oil goes up tomorrow. The bigger story is what happens if financial sanctions, shipping restrictions, energy disruption, inflation, and geopolitical retaliation begin reinforcing one another. Because when those forces connect, the impact can spread far beyond Iran. It can reach Asia, Europe, the United States, emerging markets, airlines, manufacturers, consumers, and eventually your wallet. So what exactly is Washington trying to achieve? Why is Iran threatening retaliation? Why are oil traders sometimes selling even while geopolitical risks are rising? And what would have to happen for this situation to become a genuine global market shock? To understand that, we need to start with the weapon that does not explode: money. For years, the United States has used financial sanctions as one of its most powerful tools against Iran. The basic idea is simple. If you cannot stop an adversary directly, you can make it harder for that adversary to earn, move, borrow, insure, and spend money internationally. And in August 2026, Washington has been escalating that strategy. The U.S. Treasury has targeted networks accused of helping Iran move foreign currency through shadow banking channels. It has also targeted digital asset exchanges and financial networks connected to Iranian illicit finance. And the latest pressure goes even further. The United States is warning that companies and countries continuing to support Iranian trade could face consequences themselves. That changes the calculation, because suddenly, doing business with Iran is no longer just a question of whether Iran can pay. It becomes a question of whether the foreign company can afford the consequences of being connected to Iran. Imagine a bank in another country. It has one client generating profitable business with Iranian companies. The bank could keep the relationship. But if Washington threatens access to the U.S. financial system, the calculation changes. The bank may decide that one Iranian customer is simply not worth the risk. Then another bank makes the same decision. Then an insurer. Then a shipping company. Then a trading house. Then a logistics provider. And suddenly, sanctions are no longer just a list of names on a government website. They become a network of incentives. That is where financial pressure becomes powerful. But there is a problem. Iran is not an isolated economy sitting outside the global system. Iran is connected to energy markets. It is connected to China. It is connected to regional trade. It is connected to shipping routes. And above all, it sits next to one of the most important energy choke points on Earth, the Strait of Hormuz. Look at a map. The Persian Gulf is surrounded by some of the world's most important energy producers: Saudi Arabia, the United Arab Emirates, Kuwait, Iraq, Qatar, Iran. But there is a catch. A huge amount of the energy produced in that region has to pass through a narrow maritime gateway before reaching the wider world. That gateway is Hormuz. At its narrowest point, the strait is only about 54 kilometers wide. The navigable channels are much narrower. Yet, through this narrow passage moves an enormous volume of energy. In 2025, roughly 20 million barrels per day of crude oil and petroleum products passed through the strait, and approximately 80% of those oil flows were destined for Asia. That means the biggest immediate economic exposure is not necessarily in Washington. It is in places such as China, India, Japan, and South Korea. Now here's where the story becomes complicated. The market does not simply ask, is Iran angry? The market asks, how much physical supply is actually at risk? Those are two very different questions. And this distinction explains something that may seem strange. Sometimes geopolitical tensions rise and oil prices fall. That is exactly the kind of behavior investors have recently seen. On August 25th, oil prices dropped sharply even as the United States announced additional pressure on Iran. Brent crude fell to around $89 per barrel during the session. WTI also declined. Why? Because markets were not simply pricing the existence of sanctions, they were pricing expectations. Some investors interpreted the shift toward economic pressure as potentially reducing the immediate probability of a larger military escalation. In other words, the market can sometimes say, more sanctions today may mean less military risk tomorrow. And if traders believe the probability of a physical supply disruption is falling, oil can decline even while political tensions remain extremely high. This is one of the most important lessons in geopolitical investing. Markets do not trade headlines, they trade expected future conditions, and expectations can change faster than reality. But that does not mean the risk has disappeared. Far from it, because the real danger is what happens if expectations suddenly reverse. Imagine the market believes the situation is stabilizing. Oil falls. Shipping companies adjust. Refiners plan around the new environment. Consumers breathe a little easier. Then suddenly, a tanker is attacked. Shipping traffic falls. Insurance premiums jump. A major exporter announces a disruption. Iran threatens to restrict the strait, or Washington announces another round of sanctions targeting a much larger group of countries. The market would have to reprice the entire risk almost instantly. And that is where volatility becomes dangerous. The first market affected would probably be energy. But energy would not be the last. Think about how modern economies work. Oil is not simply something you put into a car. Oil becomes gasoline, diesel, jet fuel, petrochemicals, plastics, industrial chemicals, synthetic materials, packaging, transportation, and countless products that consumers never associate with crude oil. So when the cost of energy rises sharply, companies have a choice: absorb the cost or pass it to customers. If they absorb it, profit margins fall. If they pass it on, prices rise. And if enough companies do that at the same time, inflation becomes harder to control. That creates a second problem: central banks. Imagine inflation is already uncomfortable. Then an energy shock pushes fuel and transportation costs higher. Central banks now face a difficult choice. Do they keep interest rates higher to prevent inflation from becoming entrenched? Or do they support economic growth even though prices are rising? There is no painless answer, and that is why a geopolitical crisis can become a monetary policy problem. The consequences can move from a battlefield to an oil tanker, to a refinery, to a factory, to a central bank, and finally to a household. That chain is the real story. But there is another layer: shipping. When geopolitical risk rises, shipping does not simply stop. It becomes more expensive. A vessel may need a longer route. A company may need additional insurance. A cargo may need a different destination. A ship owner may demand a higher risk premium. And the cost eventually enters the price of the goods being transported. This is why the market impact of Hormuz extends beyond crude oil. The strait also matters enormously for liquefied natural gas. Qatar is one of the world's major LNG exporters, and a large share of Qatari LNG exports passes through Hormuz. The International Energy Agency estimates that around 93% of Qatar's LNG exports and 96% of the UAE's LNG exports transit the strait. Together, that represents close to 1/5 of global LNG trade. Now imagine a prolonged disruption. Europe could face higher gas prices. Asian buyers could compete more aggressively for available LNG cargoes. Power generators could face higher fuel costs. Electricity prices could rise. Energy-intensive manufacturers could see their margins squeezed, and countries dependent on imported energy could see their trade balances deteriorate. This is how a regional conflict becomes a global economic problem. But there is still an important question. If Hormuz is so critical, why can't countries simply use alternative routes? They can, but not enough. Saudi Arabia and the UAE have some pipelines that can bypass the strait. Those routes provide valuable flexibility, but estimates suggest only around 3.5 to 5.5 million barrels per day of crude export capacity can be redirected through alternative routes. That is far below the roughly 20 million barrels per day of oil and products that have historically moved through Hormuz. So the world has a backup system, but it is not a complete backup. Think of it like a highway with 20 lanes feeding a city, and a backup road with 5 lanes. The backup road is useful, but if everyone suddenly needs it, congestion is inevitable. and markets price that congestion before it becomes visible in stores. This is why oil traders watch Hormuz so closely. But now we have to return to Iran, because Tehran has something Washington cannot completely ignore. Iran understands its geographic position. Iran knows that Hormuz is not just another shipping route, it is a strategic liver. And when economic pressure becomes severe, Iranian officials can threaten to retaliate economically. That does not automatically mean the strait will be closed. In fact, actually closing it would also hurt Iran. Iran depends on the Gulf. Iran needs trade. Iran needs revenue. Iran needs access to customers. And Iran's own energy exports depend heavily on maritime routes. So there is a built-in contradiction. The same choke point that gives Iran leverage can also become a weapon that damages Iran itself. That is why the market must distinguish between a threat and an actual sustained disruption. The difference could be hundreds of billions of dollars. Here is a simple example. Suppose traders believe Hormuz will remain open. Oil stays around current levels. Companies continue operating. Insurance remains manageable. Then, suppose traffic through the strait suddenly drops dramatically. The market would immediately begin asking, how long will this last? How many barrels are unavailable? How much can Saudi Arabia compensate? How much can the UAE redirect? How much oil is sitting in strategic reserves? How quickly can refiners adjust? How much demand will disappear because prices are too high? And most importantly, will the disruption last days, weeks, or months? That last question is critical. A short disruption can create panic. A prolonged disruption can reshape the economy. We have already seen how sensitive the global oil market can become. Earlier in 2026, disruptions around Hormuz caused enormous swings in global supply. The International Energy Agency reported that global oil supply fell dramatically during the most severe phase of the crisis. Oil prices experienced extraordinary volatility. Refining margins surged, inventories were drawn down, and global demand forecasts were revised lower. The lesson is clear. The global economy can absorb a temporary shock, but the longer the shock lasts, the more difficult the adjustment becomes. And that brings us to the next question. Who is actually most exposed? The answer may surprise you. It is not simply the country geographically closest to Iran. Asia is extremely important. China is a major buyer of Iranian oil. India is heavily dependent on imported energy. Japan and South Korea rely heavily on energy transported through the Gulf. And many Asian economies have manufacturing systems built around imported energy and global shipping. That creates a dangerous combination. Higher oil prices, higher transportation costs, higher electricity costs, and weaker consumer demand. Imagine a manufacturer in Asia. Its factory uses energy. Its suppliers use energy. Its shipping company uses fuel. Its customers are already facing higher prices. Now its input costs rise again. The manufacturer has three options: raise prices, cut production, or accept lower profits. None is particularly attractive. Now multiply that decision across thousands of companies. That is how an oil shock can become a growth shock. And there is another country that matters enormously: China. China's relationship with Iran is particularly important because China has remained a major destination for Iranian oil. This creates a geopolitical triangle. Washington wants to increase economic pressure on Tehran. Tehran wants to preserve its revenue. Beijing wants access to affordable energy while protecting its own strategic interests. And the more Washington threatens secondary sanctions against third parties, the more complicated this triangle becomes. Because secondary sanctions change the question from will Iran be sanctioned to who is willing to risk confronting the United States to keep trading with Iran. That is a much bigger question. It involves banks, shipping companies, insurance providers, commodity traders, energy firms, and governments. And it creates a test of how much influence the U.S. financial system still has over global trade. That is why these sanctions matter beyond Iran. They are also a test of economic power. If international companies quickly comply, Washington demonstrates enormous leverage. If major trading partners find ways around the restrictions, Iran retains alternative channels. And if those alternative channels become institutionalized over time, the global financial system could become more fragmented. This is not something that happens overnight, but it is a trend investors watch closely. Because financial fragmentation can increase transaction costs. It can create multiple payment systems, different trade networks, different currencies, different insurance arrangements, and different standards for what companies consider acceptable geopolitical risk. That means the world economy could become less efficient, and less efficient economies generally pay more for trade. Now let's look at another market, gold. When geopolitical uncertainty rises, investors often seek assets they perceive as defensive. Gold is one of them. But gold is not simply a war trade. It is also influenced by interest rates, inflation expectations, currency movements, central bank purchases, and investor positioning. So if the Iran crisis pushes inflation higher while simultaneously slowing economic growth, markets could face a complicated combination: higher inflation, slower growth, greater uncertainty. That is not an easy environment for policymakers. It can also create pressure on emerging market currencies. Consider a country that imports most of its energy. If oil prices rise in dollars, the country needs more dollars to pay for the same physical amount of energy. That can weaken its currency. A weaker currency makes imports more expensive. Higher import prices create more inflation. Inflation puts pressure on interest rates. Higher interest rates can slow investment. And slower investment can weaken growth. Again, the chain begins with energy, but ends in monetary policy. This is why the phrase oil shock is too simple. The real phenomenon is a transmission mechanism. Energy affects transportation. Transportation affects goods. Goods affect inflation. Inflation affects interest rates. Interest rates affect investment. Investment affects growth. And growth affects financial markets. One geopolitical event can therefore travel through multiple economic channels. But there is also a reason not to become overly pessimistic. Markets adapt. Producers respond. Consumers respond. Governments respond. And prices themselves create incentives. If oil becomes extremely expensive, producers outside the region have more incentive to increase output. Consumers have more incentive to reduce consumption. Companies have more incentive to improve efficiency. Governments have more incentive to release strategic reserves, and traders have more incentive to find alternative supply routes. This is why the global economy is not a fragile glass object that shatters immediately. It is more like a complicated machine. When one component breaks, other components work harder. The problem is that replacement takes time, and markets do not always have time. That is why the first few days of a major disruption can be more dramatic than the eventual economic damage. Fear moves faster than ships. Fear moves faster than pipelines. Fear moves faster than new production. And fear can move faster than policymakers. This brings us to one of the biggest misconceptions about geopolitical markets. People often ask, will oil go to $150? That is the wrong first question. The better question is, what would have to happen for oil to reach $150? Because price targets without scenarios are almost meaningless. If Hormuz remains open, even under tension, the market could remain relatively supplied. If Iranian exports decline, but other Gulf producers maintain shipments, the shock could be manageable. If shipping costs rise but physical flows continue, the market could absorb the increase. But if Hormuz becomes severely disrupted, if multiple exporters lose access, if insurers withdraw, if tanker traffic collapses, and if the disruption lasts for weeks or months, then the situation changes dramatically. The market would not be pricing Iran alone. It would be pricing the possibility of a shortage across a major share of global energy flows. And that is the scenario investors fear most. But there is another hidden risk: refining. Crude oil and refined fuel are not the same thing. A country can theoretically have access to crude and still experience shortages of gasoline or diesel. Why? Because refineries are specialized. They need particular types of crude. They have geographic constraints. They have transportation constraints, and they can be disrupted independently. That means a global energy crisis can appear first in refined products: diesel, gasoline, jet fuel. And this matters because transportation depends heavily on those fuels. Truck fleets, ships, airplanes, agricultural machinery, construction equipment, emergency services. The modern economy runs on them. So if diesel prices surge, the cost of moving food can rise. If jet fuel rises, airline tickets can rise. If shipping fuel rises, imported goods can become more expensive. The consumer may never hear the word Hormuz, but the consumer can still feel Hormuz at the supermarket, at the gas station, on an airline booking page, or in the price of a delivered product. Now consider the political consequences. Higher energy prices are not just an economic problem, they can become a political problem. Governments do not like seeing gasoline prices rise. They do not like inflation. They do not like angry consumers, and they do not like recession. That creates pressure for governments to intervene. Subsidies, tax cuts, strategic reserve releases, price controls, emergency measures. But every intervention has a cost. A government subsidizing fuel is spending money. A government releasing strategic reserves is using a finite buffer. A government cutting taxes loses revenue. And a government controlling prices can distort supply and demand. So policymakers face the same dilemma as businesses. There is no free solution. Now return to Washington's strategy. The purpose of sanctions is not necessarily to create a global oil crisis. In fact, the United States has an incentive to avoid one. A major oil shock would hurt American consumers too. It could raise inflation, it could complicate monetary policy, it could hurt businesses, and it could create political pressure at home. So the ideal outcome for Washington would be very different. Maximum financial pressure without maximum physical disruption. That is the central balancing act. Punish Iran economically. Reduce its ability to finance military and strategic programs. Pressure its trading partners. But avoid a chain reaction that destabilizes global energy markets. The difficulty is that sanctions can produce unintended consequences. If pressure becomes too strong, the targeted country may retaliate. If retaliation disrupts shipping, the economic cost spreads. And once markets begin reacting, policymakers may lose control of the narrative. That is the dangerous part. Escalation does not always happen because someone wants a global crisis. Sometimes it happens because each side believes the other side will back down. One side increases pressure, the other responds. The first side interprets the response as weakness, so it increases pressure again, and the cycle continues. Financial markets are extremely sensitive to that kind of feedback loop. But there is another signal investors should watch, not just oil prices, the shape of the oil futures curve. If traders suddenly become much more concerned about immediate supply, near-term oil contracts can rise relative to later contracts. That tells us something important. The market is not simply expecting higher prices someday. It is worried about physical availability now. That distinction matters. Another signal is shipping insurance. If war risk premiums explode, the cost of transporting energy can rise even before physical supply falls dramatically. Another signal is tanker traffic. If the number of vessels crossing Hormuz falls sharply, that can indicate that traders are becoming unwilling to take the risk. Another signal is refinery margins. If gasoline, diesel, and jet fuel become unusually expensive relative to crude, refiners may be struggling to obtain the right feedstock. And another signal is inventories. Inventories tell us how much time the system has to absorb a disruption. High inventories provide breathing room, low inventories remove it. So, if you want to understand the Iran market story, do not watch only one number. Watch the system: oil, gas, shipping, insurance, inventories, currencies, interest rates, and the behavior of governments. The market is telling a story through all of them at once. And right now, that story is mixed. On one hand, oil prices have recently fallen despite additional U.S. sanctions. That suggests traders are not currently pricing the worst-case scenario. On the other hand, the underlying supply system remains vulnerable. The IEA has warned that continuing disruption around Hormuz has already reduced global oil supply forecasts for 2026. It has also reported unusually high refining margins and significant pressure on product markets. So the risk has not disappeared. It has simply changed form. And that distinction is critical. The world may not be facing an immediate oil apocalypse, but it may be facing a period of elevated volatility. And volatility itself has an economic cost. Businesses cannot plan as confidently. Investors demand higher risk premiums. Shipping companies adjust routes. Importers build larger safety margins. Consumers postpone purchases. Companies delay investment. And governments prepare emergency measures. Even if the worst-case scenario never happens, the possibility of it happening changes behavior. That is the invisible cost of geopolitical risk. Now imagine two possible futures. In the first future, diplomacy improves, shipping routes stabilize, oil flows recover, sanctions remain but become predictable, energy prices gradually normalize, businesses regain confidence, investment returns, inflation pressure eases, markets breathe again. That is the soft landing scenario. But there is another future. The sanctions expand, Iran retaliates, shipping traffic falls, insurance costs surge, oil exports decline, Asian buyers compete for alternative supply. European energy costs rise, inflation accelerates, central banks become more cautious, equity markets become more volatile, and governments begin treating energy security as a national security issue. That is the escalation scenario. Neither future is guaranteed, and the market is constantly moving between them. That is why oil can fall on one headline and jump on the next. The price is not just measuring barrels, it is measuring probability. Probability of disruption, probability of escalation, probability of diplomacy, probability of economic damage, and probability of recovery. This is also why headlines can be misleading. US sanctions Iran. That sounds bullish for oil. But perhaps investors believe sanctions reduce the chance of war. Oil falls. Iran threatens retaliation. That sounds bearish for markets. But if traders believe this is unlikely to affect physical flows, the market barely moves. Oil prices fall. That sounds like the crisis is ending. But perhaps the decline is simply profit taking. The market is constantly interpreting context. And context is everything. So what should investors and businesses actually watch over the next few weeks? First, the implementation of the new US sanctions. Announcements matter, but enforcement matters more. Second, the response from China and other major Iranian trading partners. If major buyers continue purchasing Iranian oil through alternative channels, the sanctions may have a weaker physical impact than the headline suggests. Third, traffic through Hormuz. This may be one of the most important real-time indicators. Fourth, shipping insurance. A dramatic rise would signal that commercial operators are becoming more concerned. Fifth, refined fuel prices, especially diesel and jet fuel, because these can transmit an energy shock directly into the real economy. Sixth, inventories. The bigger the inventory cushion, the more time the world has to adapt. And seventh, diplomacy, because in this situation, one diplomatic announcement can move markets faster than a change in production. That is what makes this crisis unusual. The most important supply variable may not be a drilling rig. It may be a negotiating table. Now let's step back. What is the bigger economic lesson? The world has spent decades optimizing supply chains for efficiency. Companies learned to minimize inventories. Manufacturers learned to source components globally. Shipping networks became increasingly interconnected. Energy markets became deeply international. This system is incredibly efficient, but efficiency comes with a weakness. Less spare capacity, less redundancy, less tolerance for disruption. That means geopolitical choke points become more important. Hormuz is one. The Suez Canal is another. The Red Sea is another. And global semiconductor supply chains have their own choke points. The lesson is not that globalization is ending. The lesson is that resilience is becoming more valuable. Companies may be willing to pay more for alternative suppliers. Governments may invest more in domestic energy. Countries may build larger strategic reserves. Manufacturers may diversify production. And investors may assign greater value to companies with flexible supply chains. In other words, geopolitical risk is changing corporate strategy. It is no longer something companies leave entirely to governments. It is becoming part of financial planning. Now think about the long-term energy transition. A crisis like this can create two opposing forces. High oil and gas prices can encourage investment in alternatives: solar, wind, batteries, electric vehicles, nuclear power, energy efficiency. But at the same time, a severe energy crisis can also encourage governments to maximize traditional fuel production because they need reliable energy immediately. So geopolitical shocks can accelerate the transition and slow it down at the same time. It depends on the country, it depends on the technology, and it depends on how long the disruption lasts. This is why the Iran story is bigger than Iran. It is a test of how resilient the global economic system has become. Can energy markets absorb another shock? Can shipping reroute? Can producers increase supply? Can governments release reserves? Can consumers adapt? Can central banks control inflation without crushing growth? And can diplomacy prevent a temporary confrontation from becoming a structural crisis? Those are the questions that matter, not whether tomorrow's oil price is up $2 or down 3, because a single trading session can be noise. The system is the signal. And there is one final paradox worth remembering. The more powerful sanctions become, the more important the physical energy system can become. If financial pressure successfully reduces Iran's ability to generate revenue, Tehran may have fewer economic options. But if Tehran believes its economic survival is threatened, the incentive to use its geographic leverage could increase. That is the paradox. Economic pressure is designed to reduce Iran's power, but severe pressure can also increase the incentive to disrupt the system around it. That does not mean disruption is inevitable. It means the risk cannot be evaluated using sanctions alone. You have to look at incentives, you have to look at capabilities, and you have to look at the cost of retaliation. So is the global market facing a new risk? Yes. But the risk is not simply Iran. It is the interaction between Iran, US sanctions, shipping, energy flows, global finance, and investor expectations. The biggest danger is not one event. It is a chain reaction. Sanctions, retaliation, shipping disruption, higher oil prices, higher transportation costs, higher inflation, tighter monetary policy, slower growth, and weaker markets. That is the chain investors should watch. But there is another possible chain: sanctions, negotiations, stabilization, reopening of shipping routes, recovery of oil supply, lower energy prices, falling inflation, and renewed confidence. Both paths are still possible. And that is why markets remain so sensitive. The next move may not come from an oil producer. It may come from a government announcement, a tanker, a central bank, a shipping insurer, or a single diplomatic meeting. In a world where capital, energy, and geopolitics are deeply connected, small events can produce very large market reactions. So do not ask only, will oil go higher? Ask, what is the market actually afraid of? Is it lower Iranian exports? Is it a wider closure of Hormuz? Is it a shortage of refined fuel? Is it a financial system fracture? Is it inflation? Or is it the possibility that diplomacy fails? Because each risk produces a different market outcome. And the investors who understand that difference will be better prepared than those who simply react to the headline. The Iran story is therefore not just a story about sanctions. It is a story about leverage. Washington has financial leverage. Iran has geographic leverage. China has purchasing leverage. Energy producers have supply leverage. Shipping companies have logistical leverage. And financial markets have something even more powerful: expectation. If expectations remain calm, the global economy can absorb a surprising amount of geopolitical stress. If expectations suddenly collapse, the same economy can experience enormous volatility. That is why the next chapter may be decided not by what has already happened, but by what markets believe will happen next. And for now, the most important question is still unanswered. Will economic pressure push the region toward negotiation? Or will it push the system toward another escalation? Because if the answer is the second one, the world may discover once again that the most important economic risks are not always found inside financial markets. Sometimes they begin in a narrow strip of water, and sometimes that strip of water can move the entire world. So keep watching the sanctions, watch the tankers, watch oil, watch LNG, watch inflation, watch the dollar, and above all, watch the Strait of Hormuz. Because the next major market move may not begin on Wall Street. It may begin there.